Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, I think the guy who's ready to open up the rest of the state of Texas, the governor, Mr. Michael Becker. How are you, sir?
My Paul is hearing that Sonny and Cher song over and over again because it's Groundhog's Day. So April 23rd, into the week 6 of this quarantine, going stir crazy. So got to actually have a driveway happy hour here because we're in the afternoon. So when we get done with this, I'm going to go see a bunch of my buddies, old apartment guys in my neighborhood, and go have some beers on a rocking chair or a folding chair 6 feet apart from each other. So be the highlight of my last 6 weeks coming up here after we get done with this podcast.
Yeah, 6 feet is the key one right there. So congratulations about making it through to see your friends. So in the podcast today, we also have the professor, Mr. James Eng, joining us. James, how are you?
Good. Thanks for having me today.
So we're going to talk a little bit about education and mentoring. We've talked to this gentleman in the past. He is in the education mentoring for apartments. You may have heard him through different venues. He is probably one of the largest providers of education in the country. People really enjoy listening to him. He's done it for a number of years. He is just not the P.T. Barnum in getting the people into the business. He's the guy who's been in it for a while. People respect him. They look up to him, and they really appreciate all his wisdom that he brings to the table. He's a graduate of Carnegie Mellon. He's a smart guy, a friend of ours. I'd like to welcome Brad Sumrok. Brad, welcome to the Old Capital Podcast.
Hey, Paul. Nice to be on today. And I have a question. So we have the governor and the professor. So who am I?
You are the apartment king. And do you get a crown with that apartment king or a robe? Or what do you get as the apartment king?
Well, maybe I get a nice crown. I don't know. I'll take a nice crown if you got one.
I always thought it was the appointment king because your license plate says that on your car. So I was always confused, Brad.
APT King, K-I-N-G, APT King. So that is actually his license plate on his car. So Brad Sumrok is the apartment king. Everybody in this space that knows him, that are members or students with Brad, he's been doing it for a long period of time. We do a lot of business with his group, and we think very highly of Brad and his team. So I want to talk a little bit about what's going on in the apartment industry these days on kind of an educational mentoring perspective and what you're advising people to do. I know that you're in constant communication with your students. You're doing these webcasts, you're doing these call-ins. I mean, I always see you putting great information out to your students. So I want to talk a little bit about that. So I'm going to kick it over to Mike and James, and let's talk to Brad Sumrok.
Hey, Brad, I appreciate you coming on. Maybe the best way to start for those that do not know much about you, maybe give a brief background on kind of how you got into the business and what you guys do.
Yeah, I mean, I started investing in apartments in 2002 after having an engineering degree and an MBA, and almost decided to go to law school. But then I picked up the Rich Dad, Poor Dad book, learned about becoming a business owner and investor, sought out education, went to some seminars, and got into the business. So I've been an apartment owner since 2002, and I've been mentoring and helping other apartment investors since 2006, been a GP in over 5,000 units, and more importantly, helped literally thousands of my students and event attendees earn double-digit returns over the years, and many hundreds have increased their net worth by over $1 million. So that's kind of the 60-second overview of what I've been doing for the past literally 18 years of my life.
So you're probably, if not the most frequent flyer I know, you're right up there. You kind of fly over all the country for both pleasure and going speaking at various venues and to various different groups across the country. How have you guys kind of evolved here? What's a lot of people, you've had you on at least twice, I think. So a lot of people might kind of know who you are and what you've done historically. What's new in your program? How have you guys kind of taken on the new challenges of shelter in place and still deliver content to your students?
Well, since I've been in the business for a long time, I have been through the 2008, what we call the great 2008 recession, and not only survived, but thrived. So what I've been doing and teaching since 2008 is doing a conservative approach with underwriting and using historical data as opposed to, the all-time low cap rates and the all-time high occupancy rates that we've had and such and such. So I've been telling my students for the past 3 years that there's going to be a downturn and they got to be prepared for it. Well, nobody saw the coronavirus coming and how quickly things went from literally a seller's market to what I would consider a buyer's market literally overnight. And so what I've been doing is I've been just pumping out tons and tons of content on what people should be doing right now as apartment investors. And I've done some free webinars that are available to the general public. And I'm doing weekly, or actually 2 times a week, I'm doing Zoom meetings with the hundreds of the Brad Sumrok students that are all over the United States and, several outside of the United States. So we're just staying in contact with our students and telling them everything that I know as I learn it on, 2 times a week. So as you know, Mike, because you're in the industry, things are a lot different today on April 23rd than they were, on April 7th. There's a lot more information about things, and things are evolving rapidly and constantly.
No question. So before we kind of get into maybe some more meat of it, I know you're mentioning you have an event coming up in a week or so. Maybe kind of talk about that and kind of get into maybe some more topical things on maybe hit some highlights of some of the things you're telling your students to prepare for and react. So maybe talk about your upcoming event.
Yeah, we're really taking this time to, create new content and new products. And one of the things we've done religiously for 7 years is 3 or 4 times a year, we've done these weekend apartment investor training events, and they're live events where, I'm teaching for 14, 15 hours about all the essentials you need to be a successful apartment investor. Well, we've had over the years, we've had literally thousands and thousands of people attend these events, but we've never done a virtual event. Because quite honestly, like our live events were very popular, we're very well attended. So on May 2nd and 3rd, while we're all here at home, it's an opportunity to get smarter at home while you're safer at home. And so we're doing our first ever online weekend apartment investor training event that we're calling Weekend to Wealth. So what I'm going to do is I'm going to teach the concepts that one would need to know to be a successful apartment investor. So it's a lot of my core content that I would teach in a live event, but I'm also going to be talking about what you need to be doing right now. And then, of course, we're going to have, providers. We're going to have Robert Helms, who's a good friend of mine and the host of the real estate radio show, is going to help us out and MC the event. Paul and James with Old Capital will be there talking about what they're doing right now with financing. So it's going to be a great online event that anyone could do anywhere in the world. And that's May 2nd and 3rd. And the website is really simple. It's weekend2wealth.com.
Perfect. Talk about maybe 1 or 2 things you're talking to your students about. What are some of the things, or are you own assets both with other people and on your own? What are 1 or 2 things that you're kind of doing right now that's a little different than a couple months ago to react and try to get ahead of the impact from all the 26+ million job loss that we now have in the United States of America?
Well, I'll address two of the many. One is underwriting. So if you're looking at buying a deal right now, you want to change your underwriting, and there's substantive changes in how I'm underwriting deals today, or even, in the next few months in the future versus how we were doing them before COVID-19. So, the market has shifted. The terms have shifted to become more buyer friendly. Pricing has shifted to become more buyer friendly. The pricing changes could range anywhere from, as little as 5% to as much as 25% based on the property and the asset class and the market where you're looking. But I think everybody would agree, even the sellers and the brokers that I've talked to, is that things have shifted. So you really want to make sure that you are modeling your deals correctly. And I'll be covering that in a lot more detail, on May 2nd and 3rd. And then the other thing, of course, is operations. So those of us that have deals like you and me, it's a totally different ballgame. So we're focused on collections. And obviously, many of us that have like agency debt, even if our local cities or counties have not suspended notices to vacate and eviction hearings, a lot of us that have Fannie and Freddie loans are prohibited from doing that. So it's really all about managing operations, maximizing collections, reaching out to our residents on a one-on-one basis, finding out who's been impacted, who's lost their jobs, working out payment plans with them, and really providing them a lot of resources, as well as to like how they could get unemployment, and how they can get other services to help them during this time.
Hey, Brad, this is James. What do you think? I mean, right now we're only a month into this, but do you see any sort of cracks in whether it's other deals or properties that maybe are going to come up in the next 6 months? What do you see as some of maybe the top causes of those deals, having to essentially be rescued or sold in the next 6 to 12 months? What do you think the major causes of deals going bad in the next 6 to 12 months are going to be?
Yeah, well, first I will say that I believe, I don't just believe, I know that there are going to be some good buying opportunities. And I also know that those opportunities are only going to be available to people that get ready and that are ready. Okay, so now is not the time to sit on the sidelines and say, I'm going to wait and wait 6 to 9 months to see how this shakes out. It's like, no, you got to be getting ready now, and you got to be staying ready, and there are going to be deals. And so what the types of deals that I'm already seeing and hearing about and getting wind of that are already coming soon are, we have deals that, one category, for example, if you were in trouble prior to coronavirus, you weren't hitting your numbers, you weren't hitting your occupancy and revenue numbers, whether it was due to whatever reason. And now we're hit with the coronavirus where we're having decreasing collections and potentially increasing expenses. Some of these deals could be in trouble if they don't have liquidity in the company bank accounts, or secondarily, their personal bank accounts that they could provide, loans. And so some of these deals, I would say in May and June, we're going to see some capital calls. We're going to see some people going into forbearance agreements, which to me, it's dead man walking. I mean, if you can't make a month or two, and right now, we're only seeing on average a decrease of say 9%, 10% collections on average across the board in April. So if you can't make your payment, and even if that doubles and goes up to 20% loss of collections and 10% in April, 20% in May, and you're already having to borrow money or loan money or raise more money, I think you're done potentially, in the next 3 to 6 months. So I think we're going to see some of that. I think we're going to see some bridge loans. And again, I've been telling people for 2 or 3 years not to do a bridge loan, because in 2008, I'm here to tell you, people were getting bridge loans in 06 and 07 with 85%, even sometimes 90% financing, with the plan to get the property stabilized and then roll it into a permanent agency loan. And that permanent agency financing wasn't readily available back in 09 and 10. It's going to be less available now, and there's going to be more reserve requirements and higher criteria to get those types of loans. So I think there's going to be bridge loans coming due where people are going to be caught with a hot potato. And so those are just a few examples that I see that will be coming up here definitely in the second half of 2020.
Do you see any difference? I mean, obviously there's a lot of similarities to the last recession. Anything different about this one in terms of, maybe some permanent changes for multifamily just based on what we've seen so far, whether it's operationally, leasing, anything that maybe you've had to adjust in your operations today that you're just going to maintain going forward?
Well, I mean, regarding some of those things, so yeah, I'd say like virtual presence. Like if you didn't have a good website and good photos and good virtual tours and abilities for, residents to pay online and abilities for prospects to view units and lease online, like that's an absolute must. And that should continue, by the way. Okay, I think that should continue. So a lot of people are innovating on the fly, and they're going to create opportunities that are going to be good for their business going forward. And then going back to like similarities with, the last recession, I mean, it's way too early to tell. Like this hit us literally overnight. I mean, we kind of saw it coming, like in, first it was in China and then Italy, and then we had some sporadic cases in the US, but I feel like all of a sudden, like really from the first week of March to the third week of March, it was like a drastic from complete everything being open to a near virtual shutdown. And I was talking to Mike Becker the other day. We met for coffee. We maintained 6 feet apart, right, Mike? But the point is like if somebody would have told us that here in the USA, the land of the free, the home of the brave, that we would be, sheltered in place with no ability to, so we're not supposed to leave unless we're doing essential business or getting exercise. If somebody would have told you that and that there wouldn't be massive protests, like I wouldn't have believed it. And yet here we are, right? So I think it's still too early to tell how this is going to impact. And what I'm doing, James, I know you came out with a model, so did we in our program for stress testing deals. And what I'm doing is I'm modeling all my deals to look like a Nike stripe or a Nike logo. So we're modeling like 10% decreases in collections in April, which was pretty accurate across the board. And then 20% decreases, say in May, and maybe as low as 30% decreases in June. And then we're going to model a slow recovery, all the way back up to, say, December, where we're back to our trailing 3 prior to coronavirus. Does that make sense? So that's how we're modeling it. Is it going to be that way? I don't know. It could be worse. It could be better. But that's what we're doing right now to model how our properties are going to perform so that we have a model and we could anticipate what we expect and communicate that with our investors.
Okay, so even if somebody was going to come in and let's say buy a new deal, the past 3 years or so, it's been pretty easy to just sort of model day one cash on cash and, put your Fannie or Freddie loan on it and, project your rental increases. But if someone's going to come in and buy a deal this year, for example, it's going to be a broken deal to some extent, and it's going to be a little bit harder to just model that. Any changes? What advice would you give to somebody who is, let's say, coming in, buying a deal? It might be they're doing a loan assumption and they're putting in $1 million in equity, but they're assuming, let's say, a $9 million loan on a $10 million deal. And the deal is broken right now. Would you advise someone to take on a deal like that? Or is it, back in the 08, 9, 10, how did you feel comfortable coming back into a deal and acquiring a deal when, the proverbial knife is falling?
Yeah, what I would do is if I were underwriting the deal, I'd underwrite April, May, June collections to be lower than January, February, March. I think any reasonable person would do that. And then I would underwrite, a slow recovery so that, say, my year one collections will probably be lower than the T12. Okay. And I still may model my pro forma rent to be achieved that it might not happen until year 2 instead of year 1. So, the impact on that obviously is going to be, I need a lower price to get the same return that I wanted pre-coronavirus. And so, that's how I would do it. Now, if you're getting new debt, then you also have to model in all the reserve requirements that the lenders are, imposing. And I know you've been talking a lot about that, so I don't need to go into that. But so the assumptions are probably going to be the better opportunity. And, if I had a deal with an assumption, I wouldn't sell it right now unless I needed to sell. So I think what you're going to see is that the people that need to sell, that are willing to, take away, say I bought a deal for 10 million and I have a $7 million loan. I think some of these people are going to need to sell for less than that, where borrowers could come in for, say less than a 20 or 30% down payment and get into what you're calling a broken deal. And, but they just got to underwrite it with realistic projections on how the deal is going to perform over these next 3 to 12 months. Does that make sense?
Yeah, it does. Do you think, a lot of times we look at, let's say, a 5-year horizon, and you're trying to get maybe, let's say, a 15% IRR. And so you might be at 70, 75% total return. Is that a reasonable expectation in today's market, or you think people should sort of reset to, 100% rate of return over 5 years? Are you raising that bar at all?
I haven't yet, but I think it's reasonable to do so, because I think that we may, we were every deal I analyze, and James, this, the listeners may not, but I analyze every deal to make sure we have an apples to apples comparison with a sale at the end of year 5. And, the last 3 to 5 years, though, the average holding period of me and most of my students has been well less than 5 years, because we've exceeded our projected returns, and we had the insight to say, hey, if I've met or exceeded my projected returns in a shorter amount of time, it might be time to consider exiting the deal so we could make sure the gains are in our pockets. And I'm sure there's people out there right now listening that didn't do that, and now they're going to be looking at probably needing to hold on to their deals for at least another 2 years. Okay. So, we may be looking at a 5 to 7 year hold now instead of a 3 to 5. And I do think it's reasonable to, and I've had some investors even ask, hey, Brad, should we be lowering our expected returns right now? And my answer is no, absolutely not. If anything, you should be increasing your expected returns.
Right. Yeah. Right now there's more risk, more uncertainty than there was 2 months ago, 3 months ago.
Yeah.
I guess, there's limited deals on the market, right? So before, everybody was focused on what's the new deal, Since there is, I think there's maybe 1 or 2 deals in DFW on the market right now. And what should general partners, what should limited partners be doing for the next, let's call it 30 to 60 days?
You're talking about people looking for deals and not with respect to managing their deal, right?
Right. Yeah. So if somebody, let's say they are brand new, they haven't bought a deal, maybe address that person, and then address the person who maybe has 5 deals already that they own. What should they be doing in this time when there isn't any deals on the market for them to go out and buy?
Well, I'm going to sound self-promotional, but if you're brand new, you got to come to my training, because I've been through a downturn. I've been doing this 18 years, and I'm going to steer you in the right direction, and you're going to leverage me and my team that's out there beating the pavement right now. I got a team of brokers that are finding those deals. And look, the only way you're going to get these, quote, I don't want to say distressed deals, but they're going to be, deals that people need to sell. And you're going to get those deals by getting ready, staying ready, building your team, leveraging other people. And, part of it's being at the right place at the right time, working with the right people. If you've been doing it 5 years, you need to be out there hitting the phones and staying relevant. Like Mike Becker said, the other day when he and I were talking, you need to stay relevant with the brokers and your team, and let people know who you are and what you're looking for and how much money you got, and that you're ready to go. So, because when these deals do come, there may not be as much competition as there was pre-coronavirus in terms of the sheer number of, buyers touring properties. But there are people, and I don't want to say like me, but I'm one of these people. I got dry powder and I'm going to buy something. I got to offset income for 2020. I'm still buying something.
I think one of the things we did talk about the other day is having a sense, Tom Kills deals, and we're sharing a story about one of the deals that we were 2 days away from getting out, and the market took it away from us. because lenders froze up and there just wasn't the capital for the buyer to get the deal done because the lender froze up. So I think that's certainly kind of back to one of your previous points about, if you have a deal and you've kind of met or exceeded your projected returns in a shorter period of time, which is basically everyone this entire last cycle for at least for a good chunk of it, you should consider selling. So I think that is something I certainly would echo and resonate, especially in particular, you are an apartment syndicator, you take in other people's capital. People want to return both of their money and on their money, and forever is not a good hold time. So I think having that, that return going full cycle, especially as you're trying to grow and scale and build your reputation, I certainly would echo Brad's sentiment to that. So we were fortunate that got a couple deals out in January, one out in early February. So kind of got those out. But, we certainly are going to be victims on one or two deals with the market making its own, a handful of deals we didn't want to own for, 2 years, 3 years, 5 years longer, whatever the future timeline is going to be. Long term, Brad, where do you see this kind of going? So, maybe say 5 years, 10 years. Where do you kind of see cap rates? Where do you see anything that's changing kind of the market selection? Because I know you always preach having, a couple key components make up the proper recipe for a good apartment market. One of that's kind of being business and landlord friendly environments. Do you see any changes of kind of to that basic recipe? And then kind of where do you see cap rates in the kind of the medium to long term, the 5 to 10 year type time horizon?
Yeah, so the recipe, I don't think the long-term recipe doesn't really change. And, to summarize what that recipe is, we like to buy B and C class properties and landlord and business friendly environments. There maybe with COVID-19, we have a new definition of what a landlord and business friendly environment really is. And, for example, we're here in Texas and, Governor Abbott is trying to get the state opened up. And then there's certain counties that are extending these shelter in place orders. So that'll be interesting, right? But I mean, overall, I'd still say Dallas County is probably overall on average a more landlord friendly area than maybe some other parts of the country. But then within Texas, it may be a little less landlord friendly. But I'm still bullish on Dallas because of the other parts of the recipe, right? Which is like diversified economy, population growth above the U.S. average, job growth above the U.S. average. So, I think the markets that I've been looking at for the last, 10 plus years are still going to hold true, at least those criteria. So the diversified economies with, job growth, population growth, you can study the migration patterns. It's the Texas Triangle, Central Florida, the Southwest, Arizona, Georgia, markets that generally have above average or average cap rates. I think these are still going to be the places to be.
Tell me a little bit, if people do not know Brad Sumrok or the Brad Sumrok program, the mentoring education, I mean, you're a national mentor. You're just not in Texas. Talk a little bit about the number of transactions you guys have done over the last couple of years and other places besides Texas.
Yeah, so just in 2019, our students did like 62 apartment deals totaling over 750 million in total purchase volume and totaling like 9,800 units. So that's just in 2019. And then we did like, similar numbers, but a little less than that in 2018 and similar, but a little less than that in 2017. So we've been growing each year. But I mean, just in the past 3 years, we've done like 25,000 units in 27 different markets. So Paul, like you said, I mean, we have students buying in, Arizona, Jacksonville, Orlando, Tampa, in some markets as far away as like Iowa, South Dakota, Tennessee, the Carolinas. We're heavy in Texas because our company is headquartered in Dallas, and I used to live in Houston, and I'm very familiar with those markets. And we have a lot of students in Central Texas and the Texas Triangle, but we are very active nationally.
So what is it like to be right every once in a while? And for you, you've been right these last couple of years. I mean, I think you were ahead of your time when you were talking about bridge loans and a little bit of the danger that bridge loans, but talk a little bit about reversion cap rates? Because if you listen to some of these folks that they're not your peers, but they're like the PT Barnums, that it's more about feelings than it is about knowledge about being in the business. I call that kind of the attack of the clones to you, is that they don't give really hands-on advice that what you do. So there's a lot of things that you've brought up in the past that a lot of listeners haven't heard, but one of the things I think is important is reversion cap rates. Can you just talk a little bit about that and why you've been talking about that for a number of years?
Yeah. So, and just so everyone knows, a reversion cap rate is what the cap rate will be when you sell the property. And I'll just start with the challenges. Okay. So some of the critics out there that are saying, oh, Brad, we don't need reversion cap rates. We just need to know how the deal is going to cash flow. Well, the problem with that, well, let me talk about why they are saying that, or why I think they're saying that, is because modeling of reversion cap rate in the future is that we don't know exactly what the reversion cap rate is going to be. Okay. But I mean, look, I'm an engineer by training, an MBA by training. I'm a CCIM by training. Anybody that could claim to do a financial analysis without a reversion cap rate, I can't understand how you could do a discounted cash flow analysis without a cap rate. Like, I just don't understand. Like, you can't do it. So the thing is, when you look at reversion cap rates, if you study history, which I do, the cap rates prior to coronavirus were at all-time lows across the board for, class A, B, C, D apartment buildings. So to me, it makes sense that in the future, they're probably going to be higher. Now, how much higher, I don't know. But so what we've been doing is we've been buying C-class deals at 6 caps, but we're modeling, maybe a 7.25 to 7.5 reversion cap rate. Okay. So what that means is that we're modeling in the future that people are willing to pay less for the same income stream. So it's a conservative approach. So the way we still get appreciation is through NOI growth, but not through cap rate compression. Does that make sense? So that's really important. And how it's really helped a lot of my students is, admittedly, we've bought some deals in 2014, 2015 that, in spite of our best intentions, some of these deals didn't hit their projected cash flows for one reason or another, whether it was, the sponsorship team, the management company, the market, or whatever. But those that sold were able to get out of these deals and make money. And why? Is because we modeled it with a higher reversion cap rate, but the market actually gave us a lower reversion cap rate. So they made money on cap rate. Does that make sense? Well, the cap rates, to me, especially now, I don't see them going up drastically, but I do see them going up a little. And if it doesn't go up, then you win as an investor. But if you model it to stay flat and your projected returns are based on, a C-class asset staying at a 5.75% cap rate over the next 5 years, I don't see how you could win. So I think that's really dangerous. And unfortunately, there's a lot of people out there who have been doing that.
Well, as you can hear, Brad, he gets into the weeds because you need to be in the weeds. Not everything is butterflies and roses. You only have to understand exactly how this stuff works. So you need to attend a meeting that Brad hosts. And again, Brad, can you give us that information one more time if somebody didn't hear it or it wasn't able to write that down of what you guys are going to do?
Yeah, the upcoming online event called Weekend to Wealth, you could just go to that website, weekend2wealth.com. And Paul, it's like $49, so it's virtually free. So I'm not out here trying to make money off of people and sell them the dream while they're at home, during the coronavirus. And if you're suffering financially, look, I don't need the $49, but the truth is we're putting in so much time and energy preparing for this event, and the value they're going to get from attending this event is potentially, I don't want to say what it is, but it could be millions of dollars, because if you learn how to buy an apartment building, it could be worth a lot. So that's weekendtowealth.com. And if they want to get just more information about me and my company and everything else we have to offer, they could go to bradsumrok.com, and there's no C in my last name. So it's BRADSUMROK.com.
Some rock and some don't. So we certainly enjoy listening to Brad, who is a mentor and education person that you need. If you get into multifamily, you need specific education. You need specific knowledge of what you're getting into. There's just too much money at risk, and you need somebody to grab you by the hand and kind of show you how to do it, where to put your money. So it is that's what Brad and his team do. So Brad, thanks for being on the show. We certainly appreciate that. James the Professor Eng, always a pleasure. And Michael Becker, we will see you next time. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.